In the previous video, we have understood the terminology and definitions for symbol, description, contract listing, contract start day and last trading day or expiry day, trading period, trading session and quotation or base value. Let's start by looking at the rest of the terminology and definitions. Trading unit.
I know trading unit is very important in a contract. Can you explain why?
Trading unit tells you the contract size. In other words, how much commodity one futures contract represents. Gold 1 kg. Crude oil 100 barrels. This is extremely important because profit, loss, margin and exposure all depend on contract size. Contract size is similar to lot size in stock futures.
Can you explain with an example?
Sure. Let me explain with an example. As of March 2026, the lot size for XYZ company futures is 400 shares. One contract of XYZ company futures represents 400 underlying shares. And any trade must be in multiples of this size. Similarly, if the contract size or trading unit of gold is 1 kg, it means that one contract of gold futures represents 100 underlying quotation or base value, which in this case is 10 grams. Any trade must be in multiples of this size. Similarly, if the contract size or trading unit of crude is 100 barrels, it means that one contract of crude futures represents 100 underlying quotation or base value, which in this case is 1 barrel. Any trade must be in multiples of this size. In subsequent video lessons, we will use the terms lot size, contract size and trading unit interchangeably when it comes to the total exposure in amounts. Similarly, we will use the term lots and contracts and trading units interchangeably when it comes to number of quotations or base value. Price quote.
What exactly is price quote?
This tells you the basis of pricing, meaning the location or price convention used. For gold, the document says the quote is X Ahmedabad with certain taxes included and GST excluded. This matters because commodity prices are linked to standard pricing conventions. Maximum order size.
Why does the exchange have maximum order size in contracts?
As the name suggests, maximum order size is the largest order quantity you can place in one order. Gold 10 kg. Crude oil 10,000 barrels. This is a market control feature. Tick size or minimum price movement.
What is the tick size?
This is the smallest price change allowed in the contract. Gold rupee 1 per 10 grams. Crude oil rupee 1 per barrel. This matters because profit and loss calculation moves in multiples of the tick size. Daily price limit.
What exactly is daily price limit and why is it important?
Daily price limit is the maximum amount the contract price is allowed to move in a day unless relaxed by the exchange. Gold starts with a slab of 3%, then can expand. Crude oil starts with a slab of 4%, then can expand. This is a risk control mechanism to prevent extreme price shocks. Initial margin.
Do traders need to pay the full contract value?
No. Initial margin is the minimum amount of money a trader must deposit upfront to take a futures position. Gold, minimum 6% or span, whichever is higher. Crude oil, minimum 10% or span, whichever is higher. This is not the full contract value. It is a security deposit. There are other types of margins as well. We will talk about margins in more detail in later videos. Quality specification.
Why is quality specification mentioned in contracts?
Quality specification defines the standard quality of the commodity underlying the contract. This is very important in commodity futures because not every gold bar or crude oil barrel is identical. Examples: gold 995 purity, crude oil light sweet crude oil with specified sulfur content and API gravity. So, the exchange clearly defines what qualifies as the commodity for that contract. Delivery unit.
What is delivery unit?
Certain commodity futures may result in delivery at end of the contract. This is unlike in the stock exchanges where most futures are settled in cash. Delivery unit is the quantity in which delivery is made if the contract is deliverable. For gold, the delivery unit is 1 kg. This often matches the trading unit. But the key point is that it defines how actual delivery will happen. Delivery logic.
There is another term related to delivery logic. What is that?
This means how the contract is finally settled at expiry. There are two broad possibilities: delivery settlement and cash settlement. Gold is effectively a delivery-oriented contract with compulsory delivery treatment at expiry for open positions. Crude oil is cash settled, which is similar to what happens in the stock market.
It is so interesting to learn and understand the terms associated in a commodities contract.
In a later video, we will go through in detail on how the delivery settlement occurs. Summary. A commodity futures contract has a standard name, size, price code, tick size, margin requirement, expiry date, quality standard and settlement method, all fixed by the exchange. This is the real meaning of standardized contract.